Thanks once again for joining us. This week or this show, we focus on sort of a trading autopsy. How do things go for you in this trade period relative to post-Tesla earnings? So the objective here is not to do a blame game, but more to sort of figure out what happened and then come up with lessons that one can apply going forward. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters for good ideas on investing in trading. Please join us on Patreon. So this week was kind of a nightmare for me. I was not trading. I do have a couple of good friends who have sort of different trading personalities, and it was it was kind of painful to listen to and watch what happened this week. So in one case, I'll call a good friend of mine, his name is John. John and I had a conversation about, okay, what's going to happen this week with Tesla post earnings? Well, his comment to me was, Tesla's had a nice run from early 100s now to almost $300 a share in not that long a period of time. So it's my expectation that we're going to be, it's a good time to take a breather just because the stock is tired. And so I listened to him and I was like, wow, great analysis. This is exactly the analysis that I came away with prior to us seeing what the earnings numbers were and the story that went with it. So I was like, man, he's really got it down. His head is in the game. I think he's going to do well during this trading period by sitting it out, waiting to see what happens, and then getting in afterwards to either buy puts or calls based on where the stock ends up going. So what happened? The answer is that he ended up losing a few grand. And the reason he lost it was that he got A on my list here of something called FOMO, fear of missing out. So there's a guy named Squawk Square that a lot of us follow. There's also, in his case, a group of traders that are kind of affiliated with his grandson. So they all decided they were going to buy 320 calls, and that if Tesla showed strong enough profit margins, those calls would be worth a great deal. And I was kind of shocked when I heard this because I was like, wait, you already reviewed the fact that the stock is not going higher because it's had a great run so far and it's a little bit tired. And so between Squawk Square buying 6,000 shares of the stock and his grandson and his buddies loading up on some shares, he was now of the opinion that, hey, this is going to be a very profitable trade and I don't want to miss out on it. And all it takes is a 20% margin for there to be a 20-30 point jump in Tesla's shares, which is kind of the thesis that got him back in. So as I shared with you in my preview, Tesla, from an investing standpoint, is pretty good because your horizon is a year or two. From a trading standpoint, I think it's kind of horrible right now. As you saw, the problem is revenue is fine, but there are a lot of moving parts right now that screw up the trading of it in the short term. Again, if you're working on a longer term horizon, it's better, but the problem is that it's not as fun to make money over a few months or years. It's a lot more fun to make it in 24 hours. So basically, FOMO can be a bad deal because you basically are eager to not miss out, and you could end up stepping in and losing a lot of money in that process. The the second thing that I wanted to review is, let's say I ask you to say Tesla's a great company and I want to buy this stock because I know the stock is going to do great during earnings. Well, that's a statement, right? As you know, with Tesla, like any other stock, there are pockets. The pocket could be, hey, you're ready, the company is doing great, the trajectory of everything is in the direction you want to go. The problem, though, is that just because you have a feeling and you repeat either the good or the bad feeling doesn't make it reality. There's a separate reality that is the market, and your ability to study, understand, and bring that knowledge to bear in your trading is a huge deal. Now, just to repeat, I'm not exclusively recommending trading only. I highly recommend investing is a better way to go. But if you're trading, you have to develop some disciplines. Now, the next thing I want to review is something that we've talked about called the put-call ratio. Now, for those of you who don't know what that is I want to call it your lean. So basically, there are as many, depending on the option strike price, there are at least 2, if not 4, call options for every put out there. What does that tell us? It tells us a lot of people believe the stock is going to be better than expected and rising, and not the opposite, which is worse than expected and declining. So why am I bringing up the put-call ratio in this case? Very simple reason. There's something called hedge funds and other institutional sort of entities that make money trading options. Well, one of the nightmares is that those market makers can see where everybody is leaning and blow those people up in the short term, even if the stock is going to do well going forward. We've seen this on countless occasions with Tesla, where the market makers, even when the news is good, will lower the stock price just because there's so many people trying to make money on those calls and end up blowing them out. So, the put-call ratio is a huge deal. Questions you should ask are, like, how many of the put-call ratios, let's say within $20 or $30 of the stock, are hugely positive, meaning way more calls than puts. And that sort of gives you a flavor for what the general ratios look like and what to expect. The next thing I wanted to review is that a straddle is not a bad deal. So in this case, we can talk about it, hindsight being 2020, but let's say you bought an equal number of puts and calls at $290 a share. That's just below where it had closed the previous day. And so you could simply have sat there and bought calls and puts at the $90 strike price. Well, what ended up happening is the stock ended up moving about 30 points. So what would have happened there is, on one hand, you would have made money on the puts as the stock fell to 260 the next day, and you would have lost money on the calls. Return on investment, like 200%. And we know that Tesla has a thing where the trend around its earnings is pretty big moves on the stock price. So the concept of a straddle is not a bad idea. Another reason why a straddle is really interesting, maybe even an imbalanced one, is that many of you own the shares. So if you were just buying puts, that would allow you to make some money as the stock price fell, because you hold a large portfolio of the stock anyway. It just ends up being a hedge on what you already own. So I think a straddle actually is not a bad, fairly good idea in this case. you know, part of, I have it written here, maxi-screw theory. So I have this theory, and I'd like to ask those of you who are serious on making money, serious on trading, to join me on what I call the maxi-screw analysis. What is the maxi-screw analysis? You've definitely heard it from me before. The maxi-screw is the fact that market makers have a beautiful technique that they do, which is their goal is to maximum screw as many traders as they can. How do you do that? The ones that they want to screw is the ones where the largest number of them are, because they're going to take the other side of that trade if they can profitably. So if you see 1, 2, 3, 4 times the calls versus puts, even if the stock price should, based on the data that went on, rise, do not be surprised if for 2 or 3 days the market makers will change the game to screw as many people as possible. So what's starting to happen as we look at the put-call ratio, maxi-screw ratio, etc., is there's this phenomenon developing where as you collect and watch these data points, you end up in a situation where you kind of have a feel for what small investors think about is going to happen, and therefore if and how you should take a position in trying to be involved in the market, particularly the dramatic moves around Tesla that happened during earnings. And then finally, in terms of data to collect, notice, Tesla is starting to throw off what I want to say is crazy data. So in this case, what we're kind of talking about is the fact that there's this thing that happens where a company is growing. As that company is growing, its revenue and profit will sort of theoretically move in lockstep. Tesla is throwing off crazy data because they had to lower their profit margins by lowering prices, but that means they have revenue rising with profit not rising as fast anymore. Is this a trend that's going to continue? That kind of trending is what results in the short-term traders bailing and destroying the stock short-term, and then they turn to the long-term investors to see what they're going to do, which in the case of Tesla is, despite missing the earnings percentage last quarter, and I think this quarter, you may actually see Tesla's stock price end up rising, and the rise is driven by the fact that long-term traders reward people for growth over time, both profit and revenue. Short-term traders can't do that. They have to be very strict to the to how investment portfolio process works, and that's why Tesla got hurt here, despite the fact that the company is doing pretty well on many fronts. So I've covered a number of sort of autopsy forensic on what happened with Tesla just now. I really think for those of you who are traders, there's an opportunity to make money there, because whenever you have delta, that's what gives you a chance to make cash. And we look forward to assisting you in that process, especially if you're a Patreon supporter. Any rate, I want to thank you for joining us today. We may do more on this, particularly if we get input from you guys, or you'd like to hear more about this. We're happy to dive into it further. Any rate, this is Greg for Teslafaninsight. Tschüss German, au revoir French, Lehitro, Hebrew, Hoda Hafez Farsi. And in Jamaica, we say enough respect, walk good man. Namaste, have a great day, and bye for now.